In this video, we're going to talk about one of the rule of thumbs that's been used for almost 30 years now when determining a safe withdrawal rate or a withdrawal rate from a portfolio that should give you a pretty high level of confidence that you will not run out of money. In future videos, maybe I'll talk about some of the other methods that are used, but in this video, we're going to talk about what's called the 4% rule. Now, if you Google 4% rule or how much can I take from my portfolio every year in retirement, you're going to get so many different articles on the 4% rule, okay? Now, this article was written almost 30 years ago now by a gentleman named William Bengen. This is William right here, this handsome fella. The title of the article is Determining Withdrawal Rates Using Historical Data. And he was a financial advisor. Now, he did not start his career as a financial advisor, which I think makes him a good candidate to write the research that he did because his background is actually in math and aeronautics. So naturally, he wrote about sustainable withdrawal rates. So what he did was he took historical market data, stock market data, and bond market data, and it looked at, from 1926, he looked at rolling 30-year returns for stocks and bonds, meaning looking at stock market and bond market returns from 1926 to 1956, 1927 to 1957, and on and on. And he kind of stress tested based on the average return over those time periods, what withdrawal rate from a portfolio during those periods resulted in not running out of money 30 years later. Okay, so he started with 6%. So if you had $1 million portfolio, in 1920s, maybe it was a $10,000 portfolio. But if you had this portfolio of stocks and bonds, and in 1926, you started with a 6% withdrawal rate, 30 years later, or $600 on a $10,000 portfolio. So if you started with 6% and we look ahead 30 years, did you run out of money? And then he did the same stress testing for various percentages, right? So he said 5%. How did you do with a 5% withdrawal rate or $500 over those 30 years in the various points in time? What he discovered was that from 1926 to about the time that he wrote this research piece in the 90s, that 4% was the sustainable starting point. So let's say today, we have a $1 million portfolio, 4% would be $40,000 annually in withdrawals from that account. And if we fast forward 30 years from today, with 4%, you should have a very high level of confidence that you will not run out of money based on the research that he did, looking at all these different periods of time going back to the early 1900s. Now, after that first year, what he also assumed was that you increased your withdrawal rate or amount by inflation. So if you started with 40,000 in year two, let's say inflation was 3.1%. So your 40,000 would increase to $41,240 and so on. Over time, the idea is that your portfolio of stocks and bonds outperforms inflation. He is assuming that it's sustainable for you to increase your withdrawal rate by inflation because of the fact that you are investing in stocks and bonds that are exceeding the rate of inflation over the course of your retirement. Makes intuitive sense, right? So a couple things that I wanted to point out with this research. Number one, which I think is extremely important, when he determined the 4% rule, I'm highlighting this for you because of the level of importance. And I quote, "This confirms our earlier observation," and what he's talking about here is scenarios where it doesn't work, which is this confirms our earlier observation that it is not a deflationary period like the Depression that is to be truly feared, but rather an inflationary period that wreaks havoc on purchasing power as well as portfolio values. So the reason why he highlights this is because of inflation following the financial crisis, the depression, of the 1920s, 1930s, World War II, etc. We were in deflationary periods, meaning your withdrawal rate was not increasing that substantially because inflation was under control. And in fact, in the 1920s, 1930s, we had deflation. So your withdrawal rate was going down. The 1970s was where the research and where retirees saw the most stress. And that's because you had a stagnant market environment coupled with high inflation, stagflation. The question is where are we today? Nobody knows, but we do know inflation is higher than we want it to be. We also know the stock market is rather expensive by historical standards, but the good news is interest rates are a lot higher than they were a couple of years ago. So Mr. Bengen did decide that 4% was sustainable because in any period, including the 1970s, that 4% was still sustainable regardless of the type of market conditions, which I think is important to highlight because the 4% rule is a good starting point, but he's also basing this research on if we experience the worst case scenario from here, that you still have a very high probability of being okay. And the question is if we look back from today to the early 1900s, are we starting at a worst case scenario looking back over the last 100 years? I don't know. Personally, I don't think so. Some people may feel that way. I hope not. But the reality is that we're probably not. And so that is an important distinction between some of these worst case scenarios utilizing that 4% rule and where we are today and what we should expect over the next 30 years. So that's my almost last point. But my last point is very important to highlight, which is all of this research is based on the fact that you're invested in a diversified portfolio of stocks and bonds. Mr. Bengen assumes that you're somewhere between 50% stocks or half of your portfolios in stocks to around 75% of the portfolios in stocks. Anything more could possibly lead to bad decision-making because of the volatility of the stock market. So kind of the sweet spot assumption in his research was somewhere between 50 and 75%. It also assumes that over these 30 years that the retiree stuck with the investment strategy, didn't alter it, didn't buy high, sell low, and was able to stomach significant portfolio drawdowns over various periods of time, specifically even thinking about the financial crisis as well. And by sticking with the investment strategy in conjunction with the withdrawal plan, that gives you the best probability of success when determining whether you're going to be okay in retirement or not. That was a lot. That was somewhat of a technical video. I hope it's really helpful. I think the biggest takeaway is when you're researching, sustainable withdrawal rates or retirement income planning online, you got to take some of this stuff with a grain of salt because yes, the 4% rule is a spectacular starting point, but it's not the end all be all. There's so much more that goes into it that I am not going to highlight in one video. We'll talk about other aspects of this in future videos. All right. Thanks. Have a great day.